Three-day losing streak on the S&P 500 from New York City this morning. Good morning, about 20 seconds away from the opening bell. Equities yesterday, dreadful. Worst day of the year so far on the S&P 500, down about 2%, trying to bounce. Futures up by about 0.1% on the S&P, on the Nasdaq up by 0.2%. There's the opening bell. Switch on the board and get to the bond market. Yields look a little something like this, down 3 basis points. The whole curve yesterday shifting 10 basis points higher. 2s out to 30s. We're down 3 this morning to 392.14 after coming very, very close to 4% on a 10-year. Euro dollar not giving me much, unchanged, 106.48, and crude giving us plenty, or taking back plenty, depending on how you look at it. Crude down, negative for a 6th straight session. We're down another 0.9%, $75 and about 70 cents. We're about 25 seconds into this one. We're positive 0.1% on the S&P. On the Nasdaq, we're up 1/3%. One stock to watch at the open, TJX, the retailer, under pressure after delivering a disappointing forecast, following the likes of Walmart, Home Depot just 24 hours earlier. Abby has more. Hey, Abby.
Hey, John, and that's exactly right. It's the outlook once again weighing on this stock. We do have the stock down about 0.8%. And one reason that it's not down more, the quarter that they did deliver, it was decent, inline EPS estimates of 89 cents per share. They also beat the same-store sales estimate, up 4% relative to the estimate of up 1.1%. But so interesting, John, this stock was not priced for perfection. The industry group overall up 13% year-to-date. TJ Maxx, including today's decline, down 2.3%. So that could be a reason that it's not down more as well. Relative to, again, that quarter that just was, it was pretty strong, in fact, in terms of the earnings. There you can see in the blue bars the 89 cents per share. And then you can also see comp sales going in the right direction. So that's a positive. Out of the pandemic, the stock is up, but not as much as you might think. I would think that it's absolutely soaring given the stay-at-home shopping trend for home. And that was a piece of the most recent quarter. They're seeing less of that. But out of the pandemic, up just about 23%. The question on today, because again, the stock is down, is it going to follow the route of Home Depot, which fell the most in a year, down 7%, or will it turn around like Walmart, up just a little bit? Again, that adjusted earnings outlook missing. Investors are a little bit concerned about that.
Abby, thank you. Different story for Baidu. Let's pick up another name, renouncing a $5 billion buyback plan after reporting better than expected results. The company CEO saying this: we have a clear path to re-accelerate our revenue growth, and we're now well positioned to make use of the opportunities that China's economic recovery offers us. That stock up by 5%. Katie Lights has more. Hey, Kaylee.
Hey, John. Yeah, nice move at the open here. Yes, revenue growth was flat, but still the figure came in above analyst expectations. You have cloud computing strength helping offset some of the weakness in advertising. And when it comes to actual profit, it doubled in the fourth quarter. One analyst over at Vital Knowledge calling that earnings growth, quote, explosive. That is largely due to cost-cutting measures, including a 23% drop in R&D. But we know there is R&D going on, including that AI chatbot they're getting ready to launch next month. Plus, the other big news here, as you mentioned, that $5 billion buyback program, which is equal to about 15% of the market cap. And of course, that market cap has gone up substantially over the last several months, John. If you take a look at the stock's performance since the low at the end of October, it is up more than 80%. Absolutely remarkable, though. It's worth noting since the recent high back on February 7th, the stock is down about 12% from then through yesterday's close. That is part of the broader cooling off we have seen in the rally for Chinese technology stocks in particular, but really Asian stocks more broadly. Now the MSCI Asia Pacific Index, as well as the Hang Seng, each only up about 3% year to date. Compare that with a 4.3% gain for the S&P 500, and of course Europe far outpacing all three of those markets, John.
Kelly Nice, thank you. Let's get you the update on the year to date and the gains on the session as well. 3 minutes into the session, we're up 0.2% on the S&P. On the Nasdaq, up about 0.5%. Year to date, up a little more than 4% on the S&P. On the Nasdaq, year to date, up a little more than 10. The Nasdaq bouncing back big time year to date. US tech companies continuing to cut costs. Intel slashing its dividend payments, preserve cash for future investments. Google extending its global layoffs within Europe, cutting 240 jobs from its operations in Ireland. Joining us now is Isabel Lee. Isabel, what's happening?
Hi, John. Macro uncertainty seems to be the big theme this year, which is why companies are rushing to cut costs. We have Intel slashing its dividend payment to the lowest in 16 years. So from 12.5 cents, they're cutting it to from 36.5 cents. They're cutting it to 12.5 cents, payable June 1st. So that's the lowest since 2007, and that's a 66% cut. Had they stayed with their current level, it would have cost more than $6 billion in 2023. The CEO did say that it plans to increase its dividend payout sometime in the future. So the chip companies, as we know, are still reeling from a steep decline, taking a hit in their profits. Intel is also eliminating jobs, and it's not the only one. Google also announcing layoffs. In Ireland, the company said it will cut 240 jobs, representing 4% of their 5,500-strong workforce. And recall that earlier this year, Google said it will cut around 12,000 jobs globally. So Google joins a host of companies drastically scaling back their operations. This includes Meta, Twitter, and Amazon. But despite this, if you look at the workforce of these companies, John, they're still not back to their pre-pandemic levels. So it remains to be seen if this cycle is indeed over.
Isabel, welcome to the show. This was great. Fantastic. Let's talk soon. Isabel Lee there on some of the big moves we're seeing in tech. RBC's Lori Calvasina saying this about markets. Looking ahead to next year, the stock market is focusing on 2024 when an earnings recovery is embedded in expectations. The key question is not whether we get a mild recession in 23. We think the market has already priced that, but whether we get one in 2024. Lori Calvasina joins us now. Lori, love catching up with you. You know that. Let's not bury the lead. Year-end price target 4,100. Do you still see upside risk to 45?
So look, we take a very quantitative approach to our targets, John, and as we go through the data, we have a few things that do point us to that 4,500 level, and so we've said that's not our base case. The preponderance of the models are getting us to 4,100, but 4,500 pops up a couple times. We see it on our valuation model, which bakes in some expansion if inflation moderates, as many have expected it to this year, and if we do get a couple of Fed cuts at the end of the year. Now, I know that's a more precarious assumption, but that's what the model gives us. If you look at the sentiment issue, which I think is maybe a little bit less controversial. If you look at the depths of individual investor sentiment at the end of last year, we were basically down around financial crisis lows for an extended period of time. And historically, when you've been below 10% in favor of the bears over the bulls, it's set you up for about a 15-16% return on the year. So that's something that gets us to a more constructive number at the end of the year. 4,100 is the base case. We still like that target very much, but we do feel like when we look at the sentiment work in particular, that if we're wrong, the bias is more to the upside in markets than to the downside.
Lori, there are phrases that people hear people at banks say a lot, things like under-owned, over-owned. We came into the year and they said that tech stocks was under-owned, and that's what suggested, really validated the rally we've had year to date. Where are we on that, and how do you gauge what is under-owned and over-owned?
So we're still pouring through the 13F data. So that's something that could potentially give us some clues. But I'll tell you, John, the street feels like it's flying blind a little bit on the institutional side because the CFTC data hasn't been coming out. And something that I like to watch there is the level of NASDAQ futures positioning. Now, what among asset managers in particular, that's been a great barometer, I would say, for the last 6 to 9 months. And it was something that really told us the market was about to kind of fall down and stumble a bit back in August because the NASDAQ futures were looking a bit over-owned. Last we saw a couple weeks ago, it looked like we were sort of midway through a rotation back in. We were watching that data very closely, but of course the CFTC issue, we just don't have that data at this particular point in time. It does feel to me though, based on conversations, there are so many people who hate this rally, who hate the rebound in tech stocks. It feels to me like they're still under-owned at this point, but we'll see what the data shows when we finally get it back.
There's this line in your research about the messy post-crisis normalization. And Lori, I just sat here thinking, what's normal anymore after a decade plus a zero race? What is normal? What are we normalizing?
Well, what I think that we're trying to get back to is what it will essentially be a new normal, where rates will be a little bit higher. We won't have the same kind of support from the Fed. But we have to get to that point. And I think the point we're trying to make with that messy normalization period is everyone has wanted to say COVID is over. And you know what? I desperately want the whole sort of COVID era in markets to be over. But if you look back to the tech bubble bursting, if you look back to the financial crisis, it took a couple years for markets to get back on their feet and for us to get
out of this period where things were chopping around a lot, when we were dealing with, sort of lingering recession fears, when we were dealing with, sort of getting out of volatility, and frankly, for lack of a better word, all the drama that was going on. And I think we're still in that period where geopolitical angst is high. Some companies are still dealing with supply chains. We're still trying to get out of this, kind of Fed period. We need to get to that pause for markets to really settle down. But that's really what we're trying to say. Not that we're, going to go back to the way we were, but we're searching for that new normal. And it is just a messy, sort of return to that new plateau.
At the epicenter of that confusion, I think the retailers were there, tech firms were there too. Tech aggressively went out and tried to build capacity. Amazon, a decent example of that. You saw the retailers build up inventories, and it all came at the wrong time and they had to drop prices. Yep. Laurie, Home Depot yesterday down 7%. They're warning that ultimately labour prices are going to hit their margins. I just wonder on the labour front, Laurie, how pronounced do you think that's going to be as a theme? And can top line growth grow quick enough in a high nominal GDP 2023 to offset some of that pressure in the middle?
I do think that margins are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor. A lot of these wage gains are going to be sticky. I think, frankly, a lot of employees were simply seeing a catch up in wages that might have been deserved in the past. And I don't want to jump down that rabbit hole, but I don't think we necessarily can assume that we're going back to sort of the wages of yesterday. So I think that is something the street is struggling to contend with right now. And frankly, John, as I think about those retailers that reported yesterday, I do understand why we had a bad day in the market, because coming into yesterday, it seemed to me a lot of the companies on the consumer side were highlighting resiliency in trends that we hadn't really seen, any kind of stumble. So I think there was a little bit of a turn that happened yesterday, frankly, that spooked markets a bit.
And Bank of America offers a bigger framework just to look at a little bit more, Laurie, and maybe I can get your opinion on that. Savita Subramaniam and the team over at BofA said this. They said the problem children from the GFC, financials, home builders and materials, and from climate risk, fossil fuels, have been starved of capital for 10 plus years. We like the capital deprived sectors. That from BofA. Laurie, does any of that speak to you?
It does, and I might focus on slightly different issues, but, I think Savita does fantastic work, and I think that's a really interesting way to look at the world. What we typically see around these big crises in markets, and again, I don't think we're completely out of the COVID era, but you tend to see big leadership shifts, right? So whatever was working heading into that crisis does not tend to be the leadership area in the market going forward. We talk a lot about industrials, which is a sector, frankly, we're neutral on. It's expensive. It has looked a bit crowded, but frankly, it's the only kind of interesting long-term secular growth theme out there that we hear when you talk about reshoring, when you talk about the trade war, COVID, supply chains, everything sort of encouraging countries and companies to make things closer to home. We think that's a dynamic that's not going to go away anytime soon. So we think, industrials may, for example, stay crowded and stay expensive for quite some time. But I like the way she's thinking about the world in terms of thinking about those paradigm shifts. I think the street is struggling to figure out exactly what those are because, frankly, there aren't a lot of, terribly interesting growth narratives out there right now. I would probably point you to a slightly different part of the market, but I do like that idea and I do like that basic construct.
Laurie, can we finish on energy? Because they were the big winners of the last 2 years, up 47, 48% in 21 and 22, up close to 60%. Laurie, they're looking at those winnings over the last couple of years and thinking, can that really repeat? Is that where the leadership's going to be in this next bull market? Even when it comes, if it's here already, I don't know. Laurie, your thoughts on that sector?
So I take a slightly different, kind of view on energy. I talk to some people, especially a lot of my clients down in Texas, for example, and I do work at a bank, that's got a lot of investment in energy across the spectrum. And I hear a lot of people trying to make a case for energy as the next big growth sector. I don't think that I quite buy that. I do like energy. I am overweight. I think it's more, though, for me, of an area that's become investable again. I look at the sector. I see, sort of shrewder management teams that are focused more on costs, that are much more focused on things like dividends and buybacks. I feel like the yield appeal of that sector is giving investors an alternative to utilities. I feel like the Russia-Ukraine war has made us understand that you can't paint ESG with a broad brush. And there is, sort of an interest there from a national security security perspective. So I feel like it's investable again. That's what I really like about the energy sector going forward. I will tell you, it's still cheap. I do think, though, the problem with this sector in the here and now is that it didn't see its earnings expectations properly adjusted for 2023 last year. So areas like energy and financials are having to go through that downgrade process right now. Once we get through that, I think it'll be, kind of a more interesting place to be. But I do, strive. I would push back on the idea that it's the next big thing in growth. I think it's just investable again and not orphaned anymore.
Well, that's a big change anyway, relative to where it was. Laurie, this was great. As always, it's good to hear from you. Laurie Calvasina there of RBC. Equities right now positive 0.25% on the S&P. Coming up, crude falling for a 6th straight day.
Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
That conversation up next.
What about what happened in Europe? That's the big one for oil. Really big warm weather shock drove gas prices down sharply, particularly in Europe. We have TTF, dropping all the way down to 49 euros a megawatt hour right now. Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
Oil extended its longest run of losses this year. WTI falling for a 6th straight session as markets await rate hike hints from the Fed minutes. This is U.S. natural gas futures dipped below $2 for the first time since 2020. Will Kennedy of Bloomberg joins us now out of London. Will, great to catch up as always. What happened to triple-digit crude on that one-way train to 3 digits off the back of China reopening?
I think two things happened. One, the change in macro conditions, the idea that rates are going to have to rise higher than people previously thought, and what that does to the dollar is always a significant headwind for commodities, and I think it's pressuring the whole complex right now. And then second, as you had Jeff Currie talking about, natural gas prices have just collapsed around the world as we've come out of the winter, and at the margin that allows for some substitution and is weighing on the broader energy markets too.
Well, how much of this is just about the weather?
In the natural gas market, it is essentially about the weather. I mean, we're through winter and it hasn't been as warm as people had expected, cold as people had feared on either side of the Atlantic, and that means that in Europe especially, there were plenty of stockpiles, and the demand for the gas just wasn't there. So the price of near-term gas futures has just collapsed. And in the US, you've seen a similar pattern, and we've had a big outage at this plant on the Gulf, which exports gas, which means that exports have been much lower than people expected. And it's just, we've seen prices in the US just collapse, down 70% since November, and as we see today, below $2 for the first time since the depths of the pandemic.
Remarkable, just an amazing turnaround. And Will, thanks for the coverage as we followed and tracked all of this. In the Bloomberg story today, available on the terminal and of course on Bloomberg.com, there's this great paragraph that just goes through the temperatures. Across the contiguous 48 states, January was the 6th warmest on record. If you go through the 6 New England states as well as New Jersey, they were warmer, the warmest ever recorded, according to the U.S. National Centers for Environmental Information. New York, Pennsylvania, Indiana had their 2nd warmest January in data going back to 1895. Just gives you an idea of how warm it's been to start the year. Looking at energy stocks struggling once again off the back of some of this, facing a 7th day of declines with the index among the worst performing sectors this year. Kelly has more. Hey, Kelly.
Hey, John. Yeah, no surprise if you're seeing declines in oil. You also don't see energy stocks hanging in there very well. That once again is the case today. You're seeing some of the majors like Exxon and Chevron under a little bit of pressure here in the first 20 minutes or so of trading, down a few tenths of 1%. But of course, this year they really have been sitting out the rally. Exxon roughly flat on the year, but both Chevron and ConocoPhillips down more than 10% on a year-to-date basis. The energy sector as a whole is down about 4% in 2023, down about 11% from its high last November. Obviously, a lot of that blame can be assigned to cooling oil prices, but we have to keep in mind the divergence we are seeing between those oil prices and the energy sector. While oil is down nearly 40% from its peak, that isn't the case for the S&P 500 Energy Index. Still, though, it is down on the year, actually the 3rd worst performing sector in the S&P 500 on a sector basis so far this year, after outperforming to almost a ridiculous margin in 2022, up 59% last year. And the 3 sectors that were closest to energy in terms of performance last year, down the least, are among the 3 sectors that are actually down the most in the S&P 500 this year as well, along with energy. So it's a story of last year's winners becoming this year's losers, John.
Big turnaround. Katie, thanks for that. About 22 minutes into the session, trying to turn around here as well, trying to bounce on the S&P, up 1/4%, on the NASDAQ, up 1/2% with some sector price action. Here's Abby. Hey, Abby.
Hey, John. And yeah, that's the first up day that we're seeing so far for the S&P 500 in 4 days. Anemic volume, 20% below the average. Not a lot of drama, as you would say, relative to the sectors. Not surprisingly, more or higher, but outside of consumer discretionary, which is not entirely intuitive given the fact that you do have TJ Maxx down, but most stocks within that sector are higher. It's up 1%. The rest of the sectors not really trading more than 0.5% one way or the other. Healthcare, utilities on bottom, so defense not bid. Over the last 2 weeks, we of course have had this pullback, and not surprisingly, we have some sectors that are down sharply, including retail, given the fact that what we did see with some of the retailers, including TJ Maxx and Home Depot. The transportation index down very sharply, down 5.4%. The semi-cap equipment stocks and the semis, the chips, they're giving back some of this year's big gain. And then the media, it's kind of interesting, John, because of course, last week, one of those boards that we were looking at on the year, up huge. Now it's some consolidation of those gains.
Abby, thank you. Your equity market broadly unchanged, positive about 1/4%. Your trading diary up next. About 25 minutes into this, equities are positive 0.2% on the S&P 500. On the Nasdaq, up about 0.33%. If you check out the bond market just briefly, big turnaround from yesterday. New highs for the year, through 470 at the close on a 2-year. Yields now lower on the session by 6 basis points. Your 2-year 466, your 10-year down 5 basis points to 389.81. Let's get to the trading diary. Fed minutes coming up at 2 p.m. Eastern time, followed by Fed speak from President Williams at 5:30, then Bostic daily on Thursday. Plus, we get US GDP, core PCE, and another round of jobless claims as well. New home sales, income and spending numbers, and UMich sentiment survey to round out the week on Friday. That rounds out this morning for me. Good morning to you. From New York City, this was the countdown to the open. This is Bloomberg TV.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, February 22nd. Here are the top market stories we are following for you at this hour. Markets await the minutes. Traders brace for clues on the Fed's thinking at its meeting earlier this month after a major bond sell-off that sent the 2-year yield to its highest since 2007 yesterday. Biden meets B9. The president is wrapping up his visit to Poland after convening with the Bucharest 9 leaders earlier today. The meeting comes after China called its ties with Russia solid as rock. o'clock. And the pulse from the port. We'll get economic insight on trade, inflation, and labor from Gene Soroka, the Port of Los Angeles Executive Director. From Washington, D.C., I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, we have about 4 hours to go until those Fed minutes drop at 2 p.m. Eastern.
2 p.m. Eastern, as you say, you look at the charts, today is a non-event. Yesterday was the event. Today we're just, as you say, waiting for those minutes, waiting for clarity. But yesterday, Kaylee, felt like a really significant moment. As you say, the 2-year really getting moved around a great deal. And finally, equities got to the point where they could no longer ignore what was happening in the rates market.
Is that code for they're listening and not fighting, Guy? Is that what we are seeing taking shape?
Well, I think finally, I think the equity market had other things to think about. The earnings season has been a factor over the last few weeks. And what is interesting about the earnings season is that equity markets have done nothing during the earnings season. They barely budged, in fact, from start to finish, if you take a look at the chart, which is fascinating. And there have been another few factors that we can throw in there as well. But generally, I think equities have been kind of looking elsewhere, trying to ignore, I think, what's been happening in the rates market. But yesterday, I think that did change. As you say, we maybe are no longer in a position where the equity market is fighting the Fed. So that, as you say, you take me there very nicely, Kaylee Lyons, is our question of the day. Has the markets, in particular the equity market, I may add, stopped fighting the Fed? Joining us now to discuss all of this, Bloomberg's Mike McKee with Kaylee in DC and Ira Jersey of Bloomberg Intelligence. Ira, let's start with you. The bond market has for a while been coming to the realization that the Fed may go further. Yesterday, the equity market maybe woke up to it. But are we now in a position where everybody's pretty aligned in the belief that the Fed is going to go further than we certainly thought even only a few weeks ago?
Yeah, well, certainly the rates market is now pricing for a pretty high probability of a little bit higher in terms of yield. But more importantly than that, it's that the market's no longer thinking that the Fed's going to cut rates aggressively starting this year. So even though there's some chance of a rate cut still priced in, it's not nearly as much. And I think what that means is at the front end of the curve, so you guys mentioned that 2-year yield moving higher. The 2-year yield, just in a scenario where the Fed goes as much as the market thinks and then kind of stays there for a long period of time, should probably be even higher than what it is. And I think if you do get then more volatility in risk assets, you get wider credit spreads, lower equity prices, then that means that the long end of the yield curve might not move much more than it already has, just because people are going to look at that part of the curve as kind of a flight to quality space for basically a place to hide.
All right, Michael McKee, I'm going to go to you since you're here with me in the D.C. studio. Clearly, Guy, he missed me too much as we used to sit next to each other in the New York office. We talk so much about the market fighting the Fed, but for a while now it has felt like the Fed hasn't been fighting the market. They haven't been pushing back on the easing of financial conditions. So if we're seeing financial conditions tightening again, are they likely to care?
Well, they're going to care because it obviously works in their advantage to have financial conditions tightening. And we're seeing that now because we are seeing rates move up across the curve. I mean, the curve has made a major move since the February 1st Fed meeting. Basically, it's a whole new story now. But the question is, does the Fed need to do more? And I'm not sure they do. They've been pretty consistent in what they've been saying all along, that we're going to go higher for longer. Remember, it was December 14th that they said they would be going to 5.1%, the consensus median dot. And so they haven't gotten there yet. So maybe they add some more on. I don't think we'll see that in the minutes today. Maybe they add some more on at the March 22nd meeting, depending on the data between now and then. But the Fed's been pretty consistent. It's the market that's had to move.
Yeah, the market has now moved. Mike, to what extent is the Fed focused on what is happening in equities? We continue to see this well-supported consumer. We can still continue to see high-end spending, discretionary spending. There has to be a link with what is happening in financial markets to a certain degree around that. Is the Fed going to be gratified to finally see that the equity market is playing catch-up?
Well, to a certain extent, because again, it does help tighten financial conditions. But the Fed's view of the markets is the markets are going to do what the markets are going to do. And what they've been doing hasn't always made sense in this first part of the year, given the Fed tightening. And so they realize they can't really jawbone it one way or another. They've been very firm in saying we're going higher for longer, and the markets went up. And now they're still saying we're going to be higher for longer, and the markets are going down. So they'll just keep an eye on it and make sure things are functioning. There is a certain, as you mentioned, wealth effect to the markets going up, and maybe some psychological impact of that, because some of those consumer confidence numbers are very influenced by what's happening in the stock market. But overall, they're more interested in the credit spreads and what people are having to pay to get credit, credit tightening, what the banks are saying about their credit standards, than what's happening in the equity market.
Well, speaking of the equity market right now, we're seeing after earlier gains, stocks dropping down toward lows of the session. We're now barely positive on the S&P 500, so maybe not a whole lot of people with conviction to put risk on ahead of those Fed minutes at 2 p.m. Eastern. So Ira, coming to you on that subject, Chairman Powell in the press conference a few weeks ago specifically flagged the minutes when he was talking about responding to a question about the conditions for a pause. He said, oh, don't worry, we're going to give you a lot of detail. What kind of detail, A, are you expecting, and what kind of catalysts could they be specifically for the bond market?
Yeah, well, so I think it's going to probably focus very heavily on their dual mandate, right? So one of the big things that I think that Chair Powell missed the opportunity to do at the last press conference was to say, under what conditions would the Federal Reserve actually ease monetary policy? Because one of the reasons why those financial conditions that you've been mentioning have been relatively easy and easing a lot is the idea that the Fed is going to cut interest rates quite aggressively in 2024. So if the minutes say something like we're only going to cut in an environment where we see job losses and the inflation rate is covered by PCE, which is obviously their preferred measure, is below 3%, that's the scenario where we might think about cutting interest rates. And I think that's even more important than exactly where they pause and where they don't hike. Yeah. Now, he sounded a little bit more dovish last time than he had in December, and it wasn't so much that it was less hawkish, but that there were more dovish comments during his press conference. So I think that that's something that needs to be clarified in the minutes, but it won't be. There'll always be two sides in the minutes, and the question is how far does it kind of edge one way or the other?
Well, most of them are economists, so they've got to have two sides to on one hand and on the other hand. Mike, let's just kind of pick up and spend a little bit more time talking about the minutes. The data since the minutes have improved quite significantly. And the argument goes something like this. If the Fed was hawkish, if these minutes are hawkish, given where the data was, how hawkish will the Fed be where the data is now? Is it possible to kind of get your arms around that?
That's going to be the thing that investors have to figure out when we see, quote unquote, how hawkish the Fed was on February 1st. I mean, these are 3 weeks old. We've seen a strong jobs report, a hot CPI report, a strong retail sales report. And so the data are telling you the Fed should be at least sounding more hawkish. I'm not sure that there's much more they can do in terms of being hawkish other than continue raising interest rates. But where they see the economy now is probably not where they saw it on February 1st. So maybe they were hawkish then. I think probably if you were being honest, you'd say on February 1st, they were being the same as they were on December 14th. They were being confident that they were going to continue raising interest rates for a while, maybe at a slower pace, but that they would hold them. And that's really kind of maybe what to look for in the minutes. Some indication, as Ira was saying, of when they might change their mind, how long they're going to hold rates high, because we're getting to a point where they're not thinking they need to raise rates significantly higher unless inflation keeps accelerating, but they need to leave it there in order to bring it down. And that's where the policy is going to slightly change and what people are going to try to divine from these minutes.
All right, Michael McKee, it was good to see your face. I know it's only been 2 weeks, but I did miss you, so it was good to see you down here in Washington.
It's nice to see you, and I would note that on Thursday it's going to be 81 degrees. That's 27, Guy, in Celsius.
Wow.
And she's here, and I'm going to be in New York where it's going to be about 30 degrees. So.
Yeah, so I'm the lucky one in this scenario. Ira, if you want to come down here and enjoy the weather in Washington, it would be great to see you here, too, in the studio. Ira Jersey of Bloomberg Intelligence. Awesome. Looking forward to it. And Michael McKee, thank you both so much. Now, coming up, we're going to get more on our question of the day. Has the market finally stopped fighting the Fed? Joe Gilbert of Integrity Asset Management is going to join us next. This is Bloomberg.
This week, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage starts February 23rd. Bloomberg, your global business authority.
You don't have inflation on such a wide range as you have now. So I'm cautiously optimistic of lower inflation, but there are some inflation that stays. It is very difficult to get sufficient labor at this point in time. So there are some bottlenecks in the system, but it's manageable, and I don't see as much inflation as last year.
That was Rio Tinto CEO Jakob Stausholm speaking to Guy earlier after disappointing earnings. So let's get back to the inflation question and how it fits in with our question of the day. Has the market stopped fighting the Fed? Joe Gilbert, Integrity Asset Management Portfolio Manager, is joining us now to give his answer. So Joe, as we look now at what could be a fourth day of losses on U.S. stocks because we've actually turned lower after initially trying to open higher, is this it? Is this the throwing in of the towel saying, you know what, Fed, you're going to win this one. We're going to go along with what you're saying here?
Hi, Kaylee, and thanks for having me on. Unfortunately, I don't think it'll be that clean. I think the market, as we've seen last year, we've gone in fits and starts. There's periods of over-exuberance and probably some irrationalization, which happened last month. where yields get kind of disconnected from the fundamentals and then equities appreciate rapidly. And then, this month now we're kind of having a little more reality coming to the system. Economic numbers are coming in a lot hotter than expected between jobs numbers, inflation numbers, retail sales. So I think that what we're actually going to have is probably, right now the market is still adjusting to the fact that the Fed is going to probably be higher for longer. I think if you look at the Fed fund futures, it's suggesting that there's no more cuts really priced into the market. And it's just more of a discounting process that, equities have to get to. And so there's going to be some winners and losers in all of this.
Joe, do you think the lows are in for the year? Do you think the lows are in compared with where we've got to in sort of September? Do you think we're going to retest those lows? Is there going to be a better entry point if you want to buy equities?
As far as retesting lows back to September, Guy, I don't really envision us getting back there. I think when we were at that point in time, a lot of negativity was swirling around the market. There was concern about earnings. We've kind of gotten through earnings now, and we have a better sense that, the bottom hasn't fallen out. So right now, it really looks like, we're not going to retest those lows, I don't believe, but anything is possible. But I think that there will be probably better buying opportunities this year. After the rapid run-up in January, it looks like, February is more of a breather. I probably can see ourselves ending the quarter flattish from here until, the minutes will come out this afternoon. So we'll get a little bit a better sense of how the Fed is thinking about things.
Well, Joe, you mentioned earnings and how the bottom hasn't fallen out yet. So if we could pick up there, and Guy was talking about this point yesterday, the message we seem to be getting from a lot of corporate America, including the likes of Walmart yesterday, is right now everything's fine. Things aren't that bad. What we're unclear about is the future, the uncertainty when it comes to the macroeconomic picture. Therefore, we just don't know, hence the cautious guidance we're getting. Are we going to reach that point when the bottom does fall out, and when would you anticipate that happening?
I think that the bottom, the proverbial bottom falling out is probably not, it won't be that dramatic. I think, if we're looking for a recession, but we're not even looking for a recession now until probably next year. And that's just a function of, you can't have the level and the magnitude of the Fed funds hikes coming through the economy and not having some impact on the economy. But we still think there's just a lot of resources within the economy that won't allow for this, negative GDP quarters to happen similar to last year. So I think that what we're really going to have is probably more of a protracted slowdown sometime next year. I think that gives the investors a little bit of leeway for this year, because ultimately right now we're really in a Fed-driven market. So that's more of and which is, premised on where inflation goes. And we think inflation is peaked, it's probably going to slow. And when inflation falls, then multiples have a chance to expand.
Joe, when I think about the Fed, though, and as you say, maybe we are in a Fed-driven market right now, but if I think about the Fed, has the Fed broken anything yet? Because normally the Fed breaks something. I look at housing, and housing's down pretty sharply. I look at some tech stocks. They've certainly been dinged up pretty bad. But nevertheless, if you think about the scale of the magnitude of the hikes that we've seen, I'm surprised how little damage has been done thus far. When does the point, are we going to get to that point where the Fed does break something, and break something quite significantly?
I think that's probably the question of the day there, Guy. I think that ultimately the Fed will, we envision that something will break here because typically whenever you have a rapid Fed hiking cycle, something ultimately breaks on the margin. So, initially when we saw crypto last year, we thought that was the tip of the sword. That didn't turn out to be. We're still watching things like commercial real estate. Somewhere there, unfortunately, we never know what's going to break. That's why it breaks. We just know that something's going to happen. As of right now, in the last 6 months, the Fed has hiked 225 basis points, which means that there's 225 basis points of tightening in the pipeline that hasn't even hit the economy yet. So, when you think about things in that context, it's right for investors to be a little bit cautious here.
Fair enough. Joe, great to get your take on things. Always a pleasure to have you on the show. Joe Gilbert, Integrity Asset Management Portfolio Manager. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Bloomberg's learned that JP Morgan Chase has curbed its staff use of the ChatGPT chatbot. ChatGPT has spurred buzz around its potential in everything from writing poems to creating stock portfolios. But there have been reports about inappropriate interactions and errors in its results. Tesla is prioritizing battery cell production in the U.S. over its factory in Germany. The reason? President Biden's Inflation Reduction Act, which includes manufacturing tax breaks. The new law's incentives have fueled concerns that Europe will fall behind in the race to attract production of electric vehicle components. And the biggest maker of computer processors, Intel, is slashing its dividend payment by 66%. The company wants to preserve cash for investment. In its earnings report last month, Intel forecast one of the worst quarters in its history. Chip companies have been hammered by a steep drop in demand for personal computer processors. And that is your latest Business Flash. Kaylee.
Ritika, thank you so much. So let's pick up on that Intel story, Guy, because I actually think this is fascinating. We have seen a number of companies across all of the different segments of technology saying, okay, we have to start controlling costs because growth is just not what it was over the last several years. Largely that has come from cuts to headcount, and Intel is doing that too. We have seen job cuts there and really across the board. But it's interesting to see it coming now to shareholder payouts. I mean, a 66% cut to the dividend is substantial. We're talking about the lowest in 16 years.
That's not the biggest shock. The biggest shock to me is that Intel stock, like a moment ago, I looked at the screen, it was up. It's barely budging on the back of this. So presumably investors must have been anticipating this. Yeah. They must have been expecting, given the investment program that this company is going through as well, it is also significantly sticking to some of its targets in terms of what product it expects to get to market when, which is significant as well. We're going to get NVIDIA out a little bit later on as well, which is another fascinating story. So it's a big day for chips. NVIDIA in some ways gets affected by the PC slowdown as well, but it's now being seen as well as being the kind of the new AI proxy in some ways. Look at what's happened with NVIDIA stock over the last few weeks. It's been fascinating. I am stunned in a market that is basically going sideways today that Intel isn't getting dinged up more today than it is.
Well, I wonder, too, how much of this is reward from investors for attempting to control costs, because we also have seen in tandem with some of these really large job cut announcements, the stock gets rewarded. It typically goes higher unless it comes alongside really dismal earnings or some kind of dire outlook. So I wonder how much of that is what's going on here, or the fact that Intel already had forecasted no good, very bad forecasts going forward. A lot of the bad news already had been priced in.
I think the question really is, was this inevitable? Had it already been priced? Mandeep Singh joins us now from Bloomberg Intelligence to give us his take. Mandeep, was this cut that we're getting today in the dividend from Intel inevitable? Is that the way we should look at it?
Yeah, and you have to look at, what the company is doing in terms of its CapEx investments and the pressure that is there in the core business, whether it's PCs or data centers. So in the end, they have to make a choice. Do they curtail their CapEx and keep paying the dividend, or they continue to invest in CapEx and, the CHIPS Act and all the governments that are keen to bring that manufacturing onshore? That is where I think they're making this tough choice of cutting the dividend right now.
Is this a Mandeep, an Intel-specific story, Mandeep, or do you think we're going to see other players having to start making these cuts to shareholder returns as well?
Well, so when you look at the semi landscape, you have to think of the different end markets. PCs is an end market that is saturated, that's going through a big inventory correction. You can't say the same about auto chips or data center chips. There, the demand continues to hold remarkably well. And that's where I think companies with the right exposure will continue to do well, both in terms of top line and maintaining their free cash flow. Intel, on the other hand, has, a double whammy here in terms of both having a higher exposure to PCs as well as having to invest in terms of process nodes. So that's why you're seeing that specific to Intel.
Mandeep, not got long here, but we're going to see NVIDIA numbers later, a little bit later. Is NVIDIA now an AI proxy stock?
At least the market is treating it that way. I would say AI infrastructure involves a lot more than what NVIDIA has to offer, but NVIDIA has the highest ASP component when it comes to, the data center infrastructure you need to run those ChatGPT type of workloads. NVIDIA's chips are the core, and that's where I think the market is treating as the proxy for AI and ChatGPT right now.
It's going to be fascinating to see the numbers a little bit later on. Is the market going to look through bad news now and potentially, as you say, treat the stock in that way? Mandeep, thanks for jumping on set with us. Really appreciate it. Mandeep Singh of Bloomberg Intelligence. Coming up, we're going to look at capacity at U.S. ports. Gene Soroka, Port of Los Angeles Executive Director, joining us next. West Coast ports have seen 6 months sequential down months. It's amazing. We're going to talk to Gene about what comes next. China, obviously a big factor here. That's coming up. This is Bloomberg.
We are an hour into the U.S. trading session, and we can't really seem to decide on direction. Bloomberg's Abigail Doolittle is tracking the move. So, Abigail, maybe a holding pattern until we get those Fed minutes?
Maybe so. Chris Murphy, or excuse me, we did have a guest yesterday on Options Insight talking to us, Chris Murphy of Susquehanna, that he thinks it's a wait-and-see mode, and that does appear to be the case, given the fact that we have the S&P 500 and the other major indexes flip-flopping between gains and losses. Right now, we're looking at a 4-day loss, the longest of the year and the worst of the year. On anemic volume, though, 20% below the recent average. Yields in just a little bit ahead of those Fed minutes, and you can also see oil lower, which on the one hand, if you include it as a risk asset, it seems a little bit risk off. On the other hand, from an inflationary standpoint, maybe oil being down 2% or almost 2% is a good thing. Now, speaking of yields and the Fed, let's take a look at a 2-year yield. This chart is just wild. So this, of course, goes back to the GFC, and you can see when it was sky high, and then the quantitative easing and the response, the accommodation accommodation from the Fed that kept it low. Now we're basically at those levels. We, of course, have the Fed minutes coming out later today. We have a 2-year auction. It's going to be interesting to see whether or not this yield goes to 5%. I would make the case, technically at least, from a chart perspective, it is likely to go above 5% very quickly. What will that do for stocks? Well, if we go into the Bloomberg terminal, this chart is really, really interesting. So this is the S&P 500 more recently over the last 6 months or so. And instead of looking at the bear market of last year, take a look at this. We're basically looking at a sideways trend. There's more of an uptrend that we're looking at here. Now, when I put this chart together yesterday morning, yesterday's candle was above the blue line by a lot. Now we're basically right on it. That's one level of support. The next level of support is the 200-day moving average. If those hold, it suggests that the S&P 500 is going to bounce higher and that this will prove to be a bottoming pattern. If not, then, well, it's going to be interesting to see what happens. I know a lot of people out there think that there could be some kind of crash. This chart does not point to that right now. It seems more likely to hold, but let's see. As for some of the earnings stories this week, all about retail. Yesterday, of course, was Walmart and Home Depot. Home Depot finishing down 7%, the worst day in a year. This, of course, on a number of issues, but one of them being the profit outlook. Now, we have TJ Maxx reporting today. The quarter that they just reported, it was in line, 89 cents, hit the mark, but we have the gross margins, and there were same-store sales were better, but the gross margins came in a little bit light. Relative to the current quarter that we're in, the comp estimate is coming in the range a little bit lighter from the estimate, and that's basically, Guy, the story for many of these numbers. I think that one of the big ones, similar to those other retailers, the overall range on the year for the earnings, it's a little bit light, that profit outlook a little bit light, and then comp sales themselves, a range of up 2 to 3%, not making what the street was looking for. Last time I looked at that stock, it was down.
Been a big week for retailing, Abigail. Thank you very much indeed. Abigail Doolittle, what's happening in the markets right now? As Abigail mentioned, TJX's stock down today, as she said, after delivering annual EPS guidance that certainly missed estimates. It's been a big week for retailing. Yesterday, we spoke to John David Rainey. He is the Walmart CFO. He talks about some of the headwinds that retailers like him, his company, are facing right now.
You're seeing that our value proposition is certainly resonating with consumers right now, but there's a lot of macro uncertainty. Again, as we look across the consumers across the globe, but certainly here in the U.S., balance sheets are getting thinner. You're seeing savings rates decline, and we really haven't been in a position where we've seen the Fed tighten at this rate. And so as we look forward and give guidance for the full year, we're adopting a cautious outlook, and we want to make sure that we're responsive to whatever environment that we're going to find ourselves in.
And that caution, I think, may be starting to show up in some of the data we're seeing from the ports. What you're getting here is, and this is basically Port of LA volumes, and we are down for the 6th straight month, which is interesting. So there's a number of factors coming together here, Kaylee. One of them certainly is maybe the caution that Walmart's talking about there. You've obviously had China being out for a long period of time. The East Coast ports are maybe taking a little bit of volume as well. But I want to reference back as well, Kaylee, to that PMI data earlier on this week. During the pandemic, we all wanted lots of stuff. Now we all want lots of services. Maybe that's the reason why we're seeing that data behind me.
Yeah, experiences, not goods, Guy. That seems to be the name of the game. So let's continue this conversation, talk about those declining volumes and more. Gene Soroka, Port of Los Angeles Executive Director, is joining us now. Gene, it's great to see you again. Give us your view through your lens of what is happening in the U.S. economy right now.
Yeah, number one, Kaylee, good morning. You've got inventory levels that are still very high. The inventory sales ratio is about 1.37, and while off its peak, it's still pretty elevated. We're getting emails and texts every day saying 30, 40, 50% discounts from our favorite retailers, and if you're like me, you're still buying. So that inventory level has to come down across the U.S. Some companies have a little different look than others, but that seems to be where we're at right now. That insatiable demand that we as American consumers sought out retail goods over the past 2.5 to 3 years seems to be dissipating a little bit, yet the January retail sales numbers with a 3% pop were outstanding.
So how long do you think this process is going to last, Gene? Great to see you, by the way. It's Guy. How long do you think this is going to last?
Well, Guy, we see a very soft first quarter. The Lunar New Year holidays for factories were extended more so than we've seen in years past. Month of February for the Port of LA will be pretty low, about 500,000 container units, well off last year's record number. And then we'll probably see softness in the second quarter. Third quarter will get us back on a more normal cadence where we'll see back to school, fall fashion, and then traditional year-end retail holiday goods start to come in.
Okay, so what does that mean for prices and freight rates specifically, Gene?
Well, you get two things, softness in the market and additional capacity coming in on the liner shipping side of the business about summertime and beyond this year. Prices will soften. Now, we're coming up at the end of this month on the traditional kickoff to that contract season with the annual Trans-Pacific Maritime Conference in Long Beach, California. That will pretty much tell us where those prices will go. They'll be off what we saw in years past.
Yeah, spot prices have come down really quite significantly. So what do you think is going to happen with contract freight rates, Gene?
They'll be lighter than normal, Guy, and realistically speaking, the liner shipping companies are going to have to fill that capacity. Higher vessel utilizations make for better unit costs, and that will be the continued drive throughout this year.
Okay, well, on the subject of cost, let's also talk about labor, because we know there is an ongoing conversation in regard to labor at the Port of Los Angeles and on the West Coast. They have been operating without a contract for 10 months now. You said as recently as in January. The sooner that gets resolved, the better. How soon is soon, Gene? What is your expectation on timing?
That's right. I think we still have a ways to go. 5 key issues that both sides are negotiating, the Employers Association as well as the dock workers across the 29 West Coast ports. Collective bargaining is hard. The 29 individual agreements have to be tied up as well. We'll probably need a couple of more months going into this, but the importers and exporters have voiced their power as well. They've shifted cargo to the East and Gulf Coast because of concerns for labor unrest. That has not happened. Productivity at the West Coast ports, and including in Los Angeles, continues to be at high levels.
Gene, I know you're not directly involved, but what are the sticking points? What still needs to be fixed with these talks?
Well, the experts will tell you on both sides they wish it could happen faster, and because they've not sat down in this type of an environment for about 8 years, going through all these details is very difficult. It'll probably come down to wage and benefit as well as the robotics and automation. And there are ways to do this properly by not leaving the worker behind. If we can get past that on the robotics side, I believe this contract negotiation can move pretty quickly.
Okay, well, right now it maybe isn't moving fast enough because it still is kind of this cloud of uncertainty hanging over the port. Gene, what effect is that having in real time?
Well, what we're at right now, Kaylee, is about 80% of normal utilization for all the cargo that's moving through. There are no ships backed up. Dwell times are down to pre-pandemic lows for cargo moving out by truck and rail. So we've got capacity to grow, latent capacity that's there for when this market picks up. But again, that uncertainty is seen by some as concern. Yet the productivity remains elevated by our dock workers, truck drivers, warehouse folks. So we've got to take this issue off the table and then focus on the value and cost that we could bring to the table to make our port the gateway of choice. And we've got to look at the regulatory environment, especially where we're talking about zero carbon and zero emissions equipment. We've got to accelerate that technology and find the necessary funding streams.
Gene, does it feel like we're going to get a recession in the U.S. economy this year to you?
No, I still don't see it. This is an economic equation, Guy, like we haven't seen. I've been through about 7 different economic shocks that we've witnessed thus far in my career, and still with low unemployment rates, high job openings, and a consumer that continues to purchase. Even with this week's guidance, I think anything we see coming down line will be shallow and short-lived, but not necessarily in a recessionary realm.
So maybe expectations have changed and changed rather quickly for the U.S. economy, Gene. They also have changed rather quickly for China, given the sheer velocity of its reopening. It happened much quicker than many anticipated, which obviously has a near-term impact, I'm sure, on the export situation from that country. But longer term, what we have seen because of how long COVID zero policies lasted is companies like those based here in the U.S. reshoring, trying to diversify their supply chains out of China. So looking out over the next several years, say decade, I'm wondering how you think that's going to change trade flows on a more permanent basis.
Kayleigh, these are trends that we're watching very closely. Whether it's nearshoring or reshoring, the shift of production and procurement to Southeast Asian nations, even into South Asia, are all front of mind for us. And we've got to be able to take advantage of these opportunities. While supply chains between China and the U.S. have been in place for 4.5 decades, they're very difficult to unwind. Yet we've got examples of companies that are trying to de-risk. When I lived in China and we had the SARS epidemic, we saw folks put into place a China plus one strategy. That has been kind of reinvented, especially with the geopolitical concerns that we have right now and folks that want to make sure they have more certainty in their supply chains.
How do you think Mexico plays in this, Gene? When you look at what is happening, the kind of production that could potentially move into Mexico, how are you thinking about how it's going to work? Do you think we're going to be seeing a completely different supply chain story in 10 years' time from now? Do you think that some certain acts that the president is pushing through at the moment are going to have a meaningful impact on that as well? I'm just wondering how you see the story developing and how you see these shorter supply chains ultimately affecting your business.
I do, and for a number of reasons. The USMCA is working well. Canada and Mexico are our two biggest trading partners. The automotive and electronics industries in Mexico have been booming as far as capabilities, skilled labor, and production. The other piece to this, too, is wages. How do Mexico wages look like compared to China as they continue to elevate, and what impact does that have on nearshoring as well? But Mexico is positioned quite well with cross-border activity, as well as that which moves pre-production for the purposes of the USMCA, content-related, for final product distributed here in the United States. Another area that will be important to the supply chain.
All right, Gene, we have to leave it there, but really invaluable insight. Thank you so much for joining us. That's Gene Soroka, Port of Los Angeles Executive Director. Now, coming up, while we have one eye off the coast of the West Coast here in the U.S., we also have our eye on Poland. President Biden is wrapping up his trip in Warsaw with a meeting with the so-called Bucharest Nine. You are seeing right now a live shot of the Beast, his transportation. Of course, he is going to get in that car, head to the international airport to get on Air Force One and head back to Joint Base Andrews later this morning. But we're going to have more details on his visit, what he accomplished in Poland just days ahead of the 1-year mark of Russia invading Ukraine. All of that is coming up next. This is Bloomberg.
keeping you up to date with news from around the world. Here's the first word. I'm Rishika Gupta. The Biden administration will cut mortgage insurance costs for some first-time home buyers. The program will be unveiled today. Borrowers with mortgages insured by the Federal Housing Administration will see their fees cut by about $800 a year, or 0.3 of a percentage point. The European Union has slashed its natural gas demand this winter by almost a fifth. That beats a voluntary 15% goal that was aimed at helping it survive the winter with lower gas flows from Russia. Finland saw the biggest drop. Usage there was cut by more than half. And China's top diplomat calls relations with Russia solid as rock. The remarks by Wang Yi come as Beijing is trying to portray itself as a neutral actor that can broker peace in Ukraine. Wang met with Vladimir Putin in Moscow. Meanwhile, the Wall Street Journal says China's President Xi Jinping is preparing to visit the Russian capital. Global News, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you so much. Well, President Biden is about to leave Poland. He is wrapping up a whirlwind trip marking 1 year since Russia invaded Ukraine. Right now, we're seeing a live shot in Warsaw of the presidential palace, the beast outside awaiting Biden as he is about to head to the airport to return to Joint Base Andrews here in the U.S. Bloomberg's Anne-Marie Hordern is there in Poland for key takeaways from the president's trip as it comes to a close. So, Anne-Marie, it was a quick couple of days. We obviously heard the president speaking in Warsaw yesterday. What were the tangible accomplishments from this trip abroad?
Really, Kaylee, it was a lot about symbolism. The president came to Warsaw as on the heels of going to Kiev to bring a message that the United States continues to stand with the Ukrainian people. And it was also a moment to really revamp this support from the allies to Ukraine. On top of that, today was really about making sure the message of a united front and defending Article 5 of NATO is paramount for this president. He talked about that yesterday in his speech, but today when he sat down with the Bucharest Nine, these are nations on the eastern flank of the NATO alliance. They are either former Soviet states or they are a part of the dissolved Warsaw Pact. So these are countries that, following Russia's invasion of Crimea and that annexation of Crimea, this Bucharest Nine was formed. And the president's message to them was, we view Article 5 as a sacred obligation. And something he reiterated once again today, as he did yesterday, was Putin wanted the Finlandization of NATO, but instead he got the NATOization of Finland and Sweden. So under Biden's watch, something that he's going to herald as a foreign policy achievement is not just keeping NATO united, but also its expansion.
Anne-Marie, this trip has gone down well with NATO allies. How has it gone down, though, back at home?